The Federal Reserve will very soon make a rate decision. And then, of course, talk about it. The press release isn't good enough. And it's funny. So this is a binary event. What I mean by that is there's two separate instances of possible movement and news release around this. At 1 o'clock, Chicago time, Central Time, a statement like this will come out from the Federal Reserve. And it will be a summary of their meeting. Now, the 12 central bank governors, each Federal Reserve district has a governor. And those 12 governors are meeting with the chairman, Jerome Powell, and they will discuss monetary policy. And, the Federal Reserve is not the Treasury. They don't issue debt. They don't determine the mix of debt in terms of Treasury bills or bonds or notes. That's what the Treasury does. The Fed is responsible for really two things. Ensuring employment growth and a healthy employment environment, and also that the price level is, i.e. inflation, stays at a reasonable amount of growth. So those are their two mandates. Now, so we've got these two mandates, and we're going to talk a little bit about what is that. So they've got these two goals. What are their set of tools? Because I think the one takeaway here, which is interesting, is they don't have a whole lot. Now, they've got words. We all have words, but they've got words. And that's part of what this text that comes out at 1 o'clock is about. Them expressing their thoughts about where rates should possibly be. Do we need to see more accommodation, i.e. lower rates, or the Fed possibly buying more securities in the marketplace to elevate the price of the securities? And remember, when Treasury prices go up, conversely, yields go down. Do they need to support that market? So the talk only gets you so far. And we've seen, for the most part, that the market has respected what the governors have said. And what I mean by that, whether or not they respect it or not, the market itself, in terms of the way they're pricing things, hasn't challenged what these guys come out and say. Now, that may change, and it could change at any time. And I've seen the releases of a statement of where the Fed thinks rates should be and where they think there should be either stimulus or the removal of that stimulus, and the market challenged that assumption. So it's a very different thing. So we get this release at 1 o'clock. Very honestly, I haven't read this thing in 5 years because, and here's the thing, if you do want to see what they're saying, it's a short read. You could certainly do it. It'll give you a sense of kind of a muted sense. It's really a summary of minutes, but what we're going to find out is anything that's in this statement is directly reflected into the marketplace. Now, some of us like, and I do too, I like to understand the nuts and bolts a little bit. So there's nothing wrong with reading it to get a little consensus of what this announcement is. But you really will find that whatever is in there it's much clearer to look at where bonds, equities, currencies, metals are trading the moment that's released versus reading the statement. Then at 1:30, the chairman will have a press conference. So he will sit down, read his own little set of prepared remarks, and then answer questions. Oftentimes, the Fed uses this as a way to kind of readjust markets' views if the initial release, the press release at 1 o'clock, does not necessarily accomplish the goals they want in terms of adding market either stability or direction. So let's jump one ahead, John, and let's talk about where Fed rates are. Now, right now in this meeting coming up, a change in rates is very unlikely. And you would think, well, Pete, you just told me the one thing they have to do, the one thing they control is not, again, the price of where treasuries trade. And what I mean by treasuries are T-bills, 90 days or 30-year notes or 30-year bonds, or 10-year notes. They don't set the price of any of those. The market does. They try to influence them via verbiage. The one thing they set are overnight rates. So that this is all they really set is what is the band. And it's really right now currently at between 0 and 25 basis points. That's the band of what they set. And it really covers what the overnight lending between financial institutions and the Fed is. So through that short-term rate is the crux of how they change monetary policy. Now, if they were to take that from a band of 0 to 25, and you would think, why is there a band? The reason there's a band is that within that range, the market fluctuates every day, just like every market does on supply and demand. But this is the target rate they like to keep. The Fed likes to keep it. Now, we've seen that in the last couple of years be up to 100 basis points, and then very quickly post-pandemic go right back down to zero again. So right now, the Federal Reserve has this rate at zero. Now, they're also buying $120 billion of Treasury securities every month. So this is something that we've never seen out of the Fed until the housing crisis, and now again recently. What that means is they actually go into the marketplace and they will buy 10-year notes, 30-year bonds, 7-year notes. They also buy mortgage-backed securities, even ETFs. So they assemble an inventory of assets. Now, you would think, why do they do that? They have this short-term rate. They do. But if they want to they have no control over longer-term rates. There's no mechanical tool for them to do it. So how can they affect them? Well, they can go in and add a price-insensitive buyer, someone who just states right up front, I'm going to buy 120 billion a month, and that's going to continue until we change our mind. And remember, you're adding a buyer into a marketplace that should traditionally elevate prices. So takeaway being, the Fed has these tools. One of them they haven't had for a long time. But if we want to take a look at how the Fed traditionally moves yields, we can see in this example. Now, what we're looking at here is something we don't trade, but are 30-day Fed funds futures. So the symbol on them is ZQ. They're not very liquid. They have a huge tick. And guys, I apologize, I'm going to get this wrong, but I want to say it's $63 and some amount of cents. And it just, there's a logic to it, not one in terms of understanding simplicity, but there is. So this Fed funds futures market during the pandemic, and we saw this, now it trades in terms of price. So how do we figure out yield? Well, unlike smalls 10s or smalls 30s or smalls 2, which show you yield, you have to take 100 and subtract the current traded price. So if we go back to January 2020 on this slide, and we see 98.4, what's the yield? What were 30-day Fed funds at that time? Well, we take 100 minus 98.4, and we come up with 1.6% or 160 basis points. So that's where these 30-day Fed funds were trading pre-pandemic. And what we saw is the Fed very aggressively, and traditionally they move in 25 basis point increments. So what I mean by that is they go from the band they're at right now, 0 to 25, they go from 25 to 50, and that's their new band, or 50 to 75 as they raise rates. Here was an instance where they very aggressively cut rates cut the Fed funds rates in a very short amount of time by a very large increments. They didn't wait and do them in 25 basis point chunks. They did it in 100 basis point chunks. So what do we see here is that we go to 100 and we minus our price, and we come up with, what do we come up with? Roughly 12 basis points. And that happens to be, not coincidentally, between that 0 and 25 basis points, the Fed touts as its rate. So this is how, when the Fed does move yields, this is one instance of how they can. If we went back another 6 years, we would see a very measured 25 basis point increase every couple of meetings that the Fed did post-housing crisis, pre-pandemic, to actually adjust and try to bring rates back to a more normalized level. Now, John, we can jump one ahead here. The Fed's activity, as we talked about now, where does it carry the greatest weight, if it carries any weight at all? What does it control? Well, really, short-term rates. Yes, it holds an inventory of longer-dated securities, but let's not worry about that right now. Really, what they change and control is this short-term rate. So where do I want to look if I want to trade the idea of an idea around what the Fed may do? Now, for me, trying to guess what they're going to do and reading that statement, and there's a lot of, you'll find a lot of analysts who will parse that statement word for word. And if they change a accommodative to moderate, they will, change an opinion on it. We're not worried about that. So what we see here is the 2-year yield market. And take a look at this. This is the exact inverse relationship of what we just looked at in Fed funds futures is that those 2 years trading about 1.6% or 160 basis points hit the pandemic. And where do we see those yields go down to? About 20 basis points. So it's a 2-year note. It's not a 30-day Fed funds or an overnight rate. So it holds a little bit more interest into it, a little bit more yield. But we see that when the Fed moves and if it moves, what's affected? That short-dated piece of paper very much. So we see that inverse relationship. This is, if we're looking to see the most reflexive part of Fed does X, what kind of is the solid Y part? It's this 2-year note. So this is something we're going to watch. John, if we jump one ahead, we're going to look at other parts of the Treasury curve here. And here we're going to see, did you bounce? Yeah. John's trying to get to the next slide. Did you get? Oh, you did, buddy. I didn't. Sorry. That's perfect, John. You're right where we're. So the Fed influences longer-term rates to a much smaller degree. And we talked about that. How do they do that? By actually buying these securities out there. But it is not that direct setting of a rate. So we look at the same time frame here. And do we see a large fall in yields during the pandemic? Absolutely. We see 10-year yields fall from 180 points or 1.8% all the way down to 48 basis points. But what we don't see is the continuation of that flat line down at that lower level. We've seen the 10-year yield resume some of its upward trajectory. So we've gone from 48 basis points all the way up to almost 180 basis points or 1.8%. Now we're a little softer as we go into this announcement, but the market's just giving back a little bit of I really believe just kind of trading a little bit of back and forth here right now. Think about this. We've almost, since the beginning of the year, we look at January 21, we were at 80 basis points. We've almost doubled the yield in the 10-year up to 160. Very low point to start with. Absolutely. So the doubling, while it sounds like a lot, it is a lot proportionally, but it's still just 80 basis points versus a more normal 10-year yield. If you want to go back and look 20 years, you're looking at a 5 to 6% yield. So it's interesting. You look at this 10, you know the Fed doesn't control it, but it will react to today's news. Whether or not there's any news or the statement is exactly the one they used last month, which is very, very likely to happen here. We could see this market move back and forth. So we're a great deal away from 5%, but we're double from where we were just in January, 6 months ago. So you see there's both sides that could be traded. And John, if we go down one more slide, just to talk a little bit about this, we want to think about, and this is on a little bit shorter scale, the S2Y, the 2 years, is more of a long-term play, while the 10s and the 30s could be day trades, and we'll look today for those day trades. And I want to talk a little bit about that. We saw a 50-point move in the 10-year yesterday. So that's a week's worth of movement. If you get your small exchange weekly newsletter that comes out on Monday, if you don't, you know what? One of the great benefits on top of lower fees and some fantastic wardrobe choices from my friend Frank Caberna, you get this tremendous piece of research. So a week's worth of movement, 50 basis points, it has covered yesterday. So what do we take a look at here? For me, what am I looking at when I look at the 2-year here? This is more of an inventory play for me. I want to hold on to some long yield. I don't mind the idea that if for some reason we trade back down to 1.3, remember, that's only moving from 16 basis points to 13 basis points. What is that? That's a $30 move. The markets can go wherever they want, but this is something that we have been, and we looked at this. When we look at true extremes, 10 years had a little bit of a recovery in terms of upside to the yield market. 30 years too. 2-year is still hugging those lows at 16 basis points. We continue to hold a little bit of this in long inventory. We feel that this is, and this Fed announcement, whether or not they cut back on those asset purchases I talked about, and I think long before they change rates, they're going to start to change some of their asset purchases. So I don't think we're going to see any kind of rate change announcement out of this. We may see a little bit of jumbling of the words, but that won't have a great sense of outtake. So is this where I want to scalp this news at 1 and 130? No. This is where I want to have a little bit of strategic position. But we always talk about, do I want to hold positions through an event? This is one I do want to hold through the event, where I'll look to take those 10s and those 30s and make them tradable